when you pick your spot, let's pick the bottom. December. We've rallied aggressively off that low in December. Now we've come into a little bit of trouble. What are you telling clients about this sector?
About semis?
Yeah.
Yeah, I mean, it's a deep cyclical. It's not for the faint of heart, but I think if you have a long time horizon and you can stomach a little volatility, there are obviously some opportunities there. I mean, so I'm still operating under the assumption that we get to some kind of resolution on trade, maybe not in the next 12 months, because I think China has a much longer time horizon than the U.S. does. They can play hardball. But assuming we get to a resolution, I think there were a lot of great buys within deep cyclicals.
Interesting.
Now, for the time being, I would stick with sectors that have less trade risk. So one of my favorite places to sort of hide, and this sounds weird, is financials. I think financials, U.S. financials, are actually one of the highest quality sectors in the S&P 500 today. They're overcapitalized. They're starting to pay real dividends. They're starting to do buybacks at a more aggressive pace. Earnings volatility for the financial sector is now lower than that of the S&P 500. I mean, I actually think this could be a good domestic kind of high quality yield play.
The problem is it has negative correlation to treasuries. So when you hide, you want to go somewhere that has positive correlation to treasuries,
I don't
utilities.
think it should.
So walk me through that.
I don't think it should have a negative correlation with treasuries. I think the market's getting financials wrong. We're trading on muscle memory. We're trading on a 2007 story that is nowhere near what financials are today. Financials leverage ratios are, I think, a seventh of where they were in 2007. I mean, this is a sector that has transformed itself, and we're not treating it that way.
I agree. The revenue streams have changed radically as well. The fee-based income is a big story that's emerged over the last 10 years. They're not so reliant on the spread story, so to speak, like they were 10 years ago. The problem is that is where the investor bias is right now, Savita, and it's rock solid. Yields go lower, banks get hit.
Don't fight the market.
What's going to change?
So I think what changes is as we look for defensive spots in the market, if you look at like low volatility funds, who's on deck to be added to a low vol fund? Financials. Financials betas have compressed significantly over the last 5 years, and they're about to be added to all of these new, kind of smart beta ETFs, these smart beta low vol ETFs. This is the new low volatility sector.